The Federal Reserve made a significant move on December 18, 2024, by cutting interest rates for the third consecutive time. This latest cut, a modest 0.25 percentage points, brings the total reduction to a full percentage point since the fall. This decision reflects the Fed's delicate balancing act as it attempts to navigate the complexities of the current economic landscape. The benchmark interest rate now sits between 4.25% and 4.5%. While this might seem high by historical standards, it represents a significant decrease from the peak rates seen in recent years. The Fed's decision to cut rates is partly driven by concerns over slowing economic growth and the potential for a recession. However, the Fed's move has not been without its critics. Some economists argue that the rate cuts are unnecessary and could even be harmful in the long run. They point to the fact that the economy is still relatively strong, with low unemployment and steady consumer spending. They fear that cutting rates too aggressively could lead to inflation. Despite these concerns, the Fed has indicated that it is prepared to cut rates further if necessary. In its official statement, the Fed said that it will continue to monitor the incoming data closely and will act as appropriate to sustain the expansion. This suggests that the Fed is taking a data-dependent approach and is willing to be flexible in its policy decisions. Inflation remains a persistent concern for the U.S. economy. Consumer prices rose by 2.7% in November 2024 compared to the previous year. This follows a 2.3% increase in October, signaling a concerning trend of rising prices. While this is a significant improvement from the peak of over 9% in June 2022, it still exceeds the Federal Reserve's target of 2%. The Fed's preferred inflation gauge, the Personal Consumption Expenditures (PCE) price index, is projected to reach 2.5% by the end of 2025. This is higher than the previous forecast of 2.1% and suggests that inflation may be stickier than initially anticipated. The Fed is tasked with keeping inflation in check while also promoting maximum employment. The recent uptick in inflation can be attributed to several factors. Supply chain disruptions, rising energy prices, and strong consumer demand have all contributed to the upward pressure on prices. The Fed's accommodative monetary policy, including low interest rates and asset purchases, has also played a role in fueling inflation. The Fed's challenge lies in striking a delicate balance. Raising interest rates too quickly could stifle economic growth and potentially lead to a recession. However, failing to adequately address inflation could erode consumer purchasing power and undermine confidence in the economy. The Fed's next moves will be crucial in determining the trajectory of inflation and the overall health of the U.S. economy. The Federal Reserve's recent interest rate cut has sent ripples through the financial markets, with stocks, Treasury yields, and the U.S. dollar all reacting to the news. The initial response from the stock market was negative, with major indexes like the Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite all declining following the announcement. The Dow Jones Industrial Average in particular has been on a downward trend, experiencing a 9-day losing streak, its longest since 1978. This decline reflects investor concerns about the Fed's outlook on the economy and the possibility of fewer rate cuts than previously anticipated. The uncertainty surrounding future monetary policy has made investors cautious. Meanwhile, Treasury yields have moved in the opposite direction, with the yield on the 2-year Treasury note rising by 0.1% and the 10-year yield climbing by 0.09%. This increase in yields suggests that investors are demanding higher returns on government debt, potentially reflecting concerns about inflation and the future direction of interest rates. The U.S. dollar also reacted to the Fed's announcement, surging by 0.77%. This strengthening of the dollar can be attributed to the currency's safe haven appeal during times of economic uncertainty. Additionally, the prospect of higher interest rates in the U.S. relative to other countries can make the dollar more attractive to foreign investors. As President-elect Donald Trump prepares to take office, a cloud of uncertainty hangs over the future of monetary policy in the United States. Trump's unorthodox economic views and his past criticisms of the Federal Reserve have raised concerns about potential political interference in the central bank's decision-making process. Trump has previously suggested that the president should have a role in setting interest rates, a stance that directly challenges the Fed's independence. This has led to speculation that Trump might attempt to influence the Fed's decisions to align with his own economic agenda, potentially jeopardizing the central bank's credibility and its ability to make objective policy choices. Despite the potential for political pressure, Fed Chair Jerome Powell has publicly affirmed his commitment to the Fed's independence. Powell has stated that he would not resign if asked by Trump, and has emphasized that the president cannot legally fire or demote him. This firm stance is crucial for maintaining the integrity of the central bank and ensuring that its decisions are driven by economic data rather than political expediency. However, there are dissenting voices within the Fed itself. Cleveland Fed President Loretta Mester and Fed Governor Michelle Bowman have expressed concerns about the pace of recent rate cuts, advocating for a more cautious approach. These internal disagreements highlight the complexities of the current economic environment and the challenges facing the Fed as it navigates a path forward amid political uncertainty and evolving economic data.